In the second quarter of 2026, the global financial matrix splintered into two entirely different realities. On one side of Wall Street, champagne corks were popping, trading floors were humming with euphoric chants, and glowing green tickers illuminated the glass towers of Manhattan. The Nasdaq Composite soared by an astounding 21.4%, marking its single greatest quarterly gain in 6 full years. Billions of dollars flooded into mega-cap technology giants, artificial intelligence, infrastructure, and pristine balance sheets. The stock market wasn't just rallying, it was putting on a masterclass in market dominance, defying every skeptic, every recession forecaster, and every bear who dared to stand in front of the big tech locomotive, but step off the floor of the New York Stock Exchange and walk into the digital ecosystem, and the mood felt less like a celebration and more like a crime scene. In June 2026, Bitcoin suffered its worst single month in 4 years, crashing nearly 19% in 30 days and collapsing straight through the psychological bedrock of $60,000. Digital wallets were drained, leveraged long positions were systematically vaporized, and the once unshakable narrative of crypto as the ultimate inflation hedge and pristine risk-on asset took a brutal sledgehammer to the face. This is the great divergence of 2026. For years, retail investors and Wall Street analysts operated under a simple, almost religious axiom. When stocks go up, Bitcoin goes up faster. When stocks fall, Bitcoin falls harder. They were glued together by the same flood of easy money, the same central bank liquidity, and the same speculative appetite. But in Q2 of 2026, that correlation didn't just break, it shattered into a million pieces. Why did the stock market experience one of its most lucrative quarters in modern history at the exact moment digital assets were undergoing an absolute bloodbath? Where did the liquidity go? Was this a massive rotation of capital from speculative crypto back into dividend-yielding corporate titans? Or are we witnessing a far more sinister liquidity trap orchestrating behind the curtains of the Federal Reserve? To answer that, we have to look past the headlines and dissect the financial machinery driving the modern world. To understand why the Nasdaq exploded by 21.4% in a single 3-month stretch, you have to look at where institutional capital goes when uncertainty meets massive profitability. In the second quarter of 2026, Wall Street didn't buy the stock market out of blind optimism. It bought a concentrated cluster of corporate monopolies that function as cash-printing utilities. The primary engine behind this quarterly surge was the relentless monetization of artificial intelligence. In previous years, AI was a speculative promise, a narrative driven by multi-billion-dollar capital expenditure announcements and lofty pitch decks. But by Q2 2026, the bill came due, and the numbers delivered. The tech behemoths, Microsoft, Nvidia, Alphabet, Meta, and Apple showed that hardware deployment had transitioned directly into top-line revenue growth. Hyperscalers reported record cloud computing margins, enterprise software adoption hit critical mass, and semiconductor supply chains finally unbottled, producing cash flows that shocked even the most bullish sell-side analysts. Concurrently, the macroeconomic backdrop delivered a Goldilocks scenario for equity traders. The Federal Reserve, after holding benchmark interest rates at elevated levels to curb persistent inflation, signaled a definitive shift toward monetary easing. Consumer Price Index data showed inflation steadily cooling toward the Fed's 2% target, while Labor Department figures pointed to a resilient yet normalizing labor market. This wasn't a crashing economy forcing panic rate cuts. It was a soft landing scenario where cooling price pressures allowed central bankers to cut borrowing costs out of strength rather than desperation. When interest rate expectations decline, valuation models recalibrate instantly. Lower discount rates mean the future cash flows of growth-oriented technology companies are worth significantly more today. Institutional asset managers sitting on trillions of dollars in money market funds, earning 5% on risk-free cash, realized that staying in cash was about to become a losing strategy. The moment yield curves began to shift, a tidal wave of institutional money exited money market instruments and surged directly into the highest quality, highest margin equities on Earth. Add to this an unprecedented surge in corporate share buybacks. Fortune 500 companies, bolstered by pristine balance sheets and record net interest income generated from sitting on cash hoards during high interest rate regimes, deployed hundreds of billions of dollars purchasing their own stock. Passive index funds, which automatically route trillions of dollars from 401 CAC contributions and institutional pensions into market cap-weighted indexes, forced automatic buying of big tech regardless of valuation. The Nasdaq didn't pump because of retail hype or speculative fever. It surged because it became the safest place on Earth to park capital in an environment of falling yields and rising corporate earnings. It was a rally built on pure balance sheet muscle, institutional rotation, and compounding cash flow. While Wall Street equity desks were celebrating record high after record high, the crypto market was enduring a slow-motion catastrophe. Bitcoin's 19% collapse in June 2026, dragging prices down below $60,000, was not a random glitch. It was the result of a mathematical liquidity squeeze that hit the asset class from every conceivable angle. First, consider the structural dynamics of the post-halving landscape. Following the April 2024 halving event, which sliced block rewards in half, Bitcoin network economics were irrevocably altered. Mining operations faced doubled production costs for every single coin minted. For 2 years, miners relied on high spot prices and transaction fee surges to maintain profitability. But as global hash rate hit all-time highs and electricity overhead surged across major mining hubs from Texas to Scandinavia, profit margins evaporated. By June 2026, underperforming mining firms faced existential pressure to cover operational expenses, pay off high-interest hardware debt, and prevent insolvency. Miners were forced to do the one thing crypto enthusiasts dread: capitulate. They dumped tens of thousands of Bitcoin directly onto spot order books, overwhelming organic buying demand. Second, the institutional narrative that propelled Bitcoin to previous highs turned inside out. The spot Bitcoin ETFs, which had seen historic inflows during their initial rollout, encountered an unprecedented period of persistent net outflows. Institutional hedge funds that had engaged in the famous basis trade, buying spot ETFs while shorting CME Bitcoin futures to capture a lucrative risk-free yield spread, saw that arbitrage opportunity collapse as futures premiums compressed. As the yield spread thinned, hedge funds closed their positions, selling off spot ETF shares by the hundreds of millions. What was once a massive buying pipe became an institutional exit door. Third, the market was suffocated by massive structural supply overhangs. Massive distributions from legacy bankruptcies, government seizures, and institutional liquidations flooded the market simultaneously. The U.S. Marshals Service, the German Federal Criminal Police Office, and the long-awaited final distributions from historic exchange collapses released tens of thousands of Bitcoin into liquid spot markets within a matter of weeks. In an illiquid market environment where buy-side market makers were retreating, even moderate selling pressure caused outsized downward price action. Finally, the leverage unwinding machine took over. Crypto derivatives markets had built up billions of dollars in leveraged long positions, with retail and algorithmic traders betting heavily on an impending summer breakout. When spot prices breached key technical support levels, first $68,000, then $65,000, and ultimately $60,000, cascading liquidations triggered automatically. Stop-loss orders hit order books, triggering forced market sells, which triggered further stop-losses in a terrifying feedback loop. In a matter of hours on peak liquidation days, hundreds of millions of dollars in paper wealth vanished into thin air. Bitcoin didn't crash because blockchain technology failed. It crashed because it exists at the far end of the risk curve, where liquidity vanishes first when institutional capital shifts from speculative leverage to cash flow certainty. For a decade, financial pundits treated risk on as a single, homogeneous bucket. If interest rates were low or falling, investors bought tech stocks, high-yield bonds, real estate, and crypto simultaneously. Everything moved together in a liquidity-driven tide. But the market dynamics of 2026 exposed a profound truth. All risk assets are not created equal. When institutional portfolio managers look at Nvidia or Microsoft, they see companies with tens of billions of dollars in liquid cash, zero short-term bankruptcy risk, massive operating margins, and pricing power that allows them to pass inflation costs directly onto consumers. These companies are not just growth stocks. In the eyes of modern asset allocators, they are defensive growth assets. If the economy stays strong, their earnings grow. If the economy slows down, their pristine balance sheets protect them, and expected Fed rate cuts make their future cash flows even more valuable. Bitcoin, by contrast, possesses no balance sheet, generates no yield, pays no dividends, and produces no quarterly earnings reports. Its valuation is derived entirely from monetary theory, network adoption, and marginal buyer liquidity. When central banks shift from aggressive money printing to quantitative tightening and disciplined monetary policy, non-yielding speculative assets face a steep hill to climb. Why did capital leave Bitcoin to chase stocks? Because in an environment where benchmark interest rates remain relatively high compared to the zero interest rate policy era of the 2010s, capital has a cost. Investors are no longer willing to park billions of dollars in unyielding digital assets when they can earn 5% in risk-free short-term treasuries, or invest in mega-cap technology companies, generating an 8% free cash flow yield. This created a classical institutional rotation. Family offices dabbled in digital assets during the peak of speculative frenzy, quietly de-risked their balance sheets. They liquidated non-yielding crypto positions and reallocated that capital into Nasdaq-listed megacaps that offered both upside potential and underlying fundamental protection. The narrative that crypto would automatically drain liquidity from traditional finance proved to be a delusion. Wall Street didn't abandon risk, it redefined risk. It chose cash-generating enterprise value over speculative digital scarcity, leaving crypto market participants holding the bag in an increasingly illiquid market structure. To truly grasp the mechanical force driving this divergence, we must peer beneath the surface of global macroeconomics and look at the Federal Reserve's balance sheet, treasury issuance, and the behavior of the United States dollar. While the headline media focuses endlessly on Federal Reserve interest rate projections, the real story lies in the plumbing of shadow liquidity. For months, the Fed continued its process of quantitative tightening (QT), letting treasuries and agency mortgage-backed securities roll off its balance sheet. Simultaneously, the U.S. Treasury Department was issuing massive tranches of national debt to fund persistent federal budget deficits. This dynamic created a sharp bifurcation in market liquidity. Traditional equity markets were insulated from QT because of the massive drawdown of the Federal Reserve's reverse repo facility, RRP. For nearly 2 years, over $2 trillion parked in the RRP facility drained out and flooded into short-term treasury bills and money market funds, effectively neutralizing the liquidity-draining effects of QT. This shadow liquidity buffer kept bank reserves high and injected continuous buying power into major stock indices. However, speculative digital asset markets do not have direct access to Federal Reserve facilities or institutional treasury repos. Crypto relies heavily on global US dollar liquidity, measured by M2, money supply growth, foreign central bank liquidity injections, and global credit creation. In Q2 2026, while domestic US stock markets absorbed domestic money market flows, global dollar liquidity remained constricted. The US dollar index DXY held a surprisingly firm range, supported by higher real yields relative to European and Asian counterparts. When the US dollar is strong and global liquidity is tight, international capital flees speculative emerging assets and returns home to US dollar-denominated prime assets. Foreign institutions and offshore traders who drive significant crypto volume face tightening credit conditions and higher dollar borrowing costs. They were forced to reduce leverage, settle dollar-denominated loans, and exit speculative token positions. Furthermore, the bond market sent clear signals. The 10-year Treasury yield fluctuated in a tight corridor, signaling that while the economy was not collapsing into a deep recession, borrowing costs for high-risk, unrated entities would remain structurally higher than during the post-pandemic era. Companies with high debt loads and speculative assets without cash flows were penalized mercilessly, while pristine corporate balance sheets in the S&P 500 and Nasdaq were rewarded with premium valuations. The macro engine of 2026 was not a tidal wave lifting all boats, it was a high-pressure pump that channeled capital selectively into systemic financial strongholds, while starving peripheral speculative markets of liquidity. The human element of the Q2 2026 market divergence reveals a classic psychological trap that is repeated throughout financial history. The gulf between institutional risk management and retail investor conviction. Throughout April and May of 2026, retail sentiment in the digital asset space was fueled by unwavering ideological conviction. Social media channels, influencer networks, and retail trading forums preached a single gospel. The post-halving supercycle was inevitable, ETF adoption was permanent, and any price dip below $70,000 was a generational buying opportunity. Retail traders, operating on emotional narratives and historical chart patterns, continuously doubled down on leveraged long positions, expecting a massive parabolic breakout toward new all-time highs. Wall Street institutions, however, do not trade on ideological conviction or social media sentiment. They trade on value-at-risk models, algorithmic momentum triggers, and portfolio rebalancing protocols. When institutional risk models flagged rising volatility, weakening spot order book depth, and declining basis spreads, algorithms systematically trimmed crypto exposure. They did not announce their exits. They executed automated, time-weighted average price (TWAP) sell orders over weeks, quietly absorbing retail buying power and converting digital assets into US dollars. When Bitcoin breached $60,000 in June, the retail community was caught completely off guard. Having exhausted their cash reserves buying previous dips, individual investors watched helplessly as liquidation cascades wiped out leveraged accounts. Panic set in. The HODL mental framework, designed for long-term spot holders, crumbled under the weight of forced liquidations and emotional exhaustion. Retail traders who had transferred funds out of traditional stock portfolios to pursue higher crypto yields were forced to realize brutal losses. Meanwhile, retail investors who remained parked in broad-based index funds or mega-cap tech stocks experienced the complete opposite reality. They opened their brokerage apps to find their 401 KEX, Roth IRAs, and index portfolios reaching lifetime highs. They didn't need to read complex white papers, monitor block explorers, or manage private keys. They simply rode the passive buying wave created by corporate buybacks and institutional pension allocations. This psychological divide amplified the market movement. Success in the equity market reinforced confidence, encouraging further retail inflows into stock index funds, while trauma in the crypto market triggered capitulation, driving retail capital away from digital assets and back toward traditional brokerage accounts. It was a masterclass in modern wealth distribution. Wall Street used retail enthusiasm as liquidity to exit speculative positions at the top, while using automated index buying to pump corporate equities to record valuations. To determine whether the 2026 divergence is a temporary anomaly or a permanent structural shift, we must examine historical market cycles where correlations broke down. In 2016, following the second Bitcoin halving, digital assets experienced long periods of consolidation and divergence from equity markets, before eventually launching into the historic bull run of 2017. Similarly, during the liquidity crisis of March 2020, stocks and crypto collapsed together. But crypto recovered at a hyper-accelerated speed due to unprecedented central bank quantitative easing. However, the financial market of 2026 is fundamentally different from 2016 or 2020. In previous cycles, Bitcoin was a localized retail-dominated market with a total market capitalization under $100 billion. It operated largely outside the regulated banking system, insulated from institutional portfolio rebalancing rules. Today, with spot ETFs, CME futures, institutional custodians, and public corporate treasury holdings, Bitcoin has been fully integrated into the global financial architecture. Integration brings liquidity, but it also brings Wall Street discipline. Bitcoin can no longer operate in a vacuum. It is now subject to the exact same portfolio management constraints, risk-off triggers, and liquidity preferences as junk bonds, emerging market currencies, and tech growth stocks. When stock market correlations broke in Q2 2026, it marked the final maturation phase of digital assets. Bitcoin is no longer a rebellious outsider, asset immune to traditional economic laws. It is an institutional asset class at the absolute top of the risk curve. When global liquidity is plentiful, it outperforms everything. When liquidity tightens or institutional priorities shift, it suffers the sharpest drawdowns. The lesson of 2026 is clear. Cycles do not repeat identical patterns. They evolve. Investors relying on simplistic 4-year halving charts without analyzing real-time central bank liquidity, treasury issuance, and corporate cash flow yield were crushed by the structural reality of modern institutional finance. As we look ahead into the second half of 2026 and beyond, the central question for every investor, trader, and institution is simple. Will this historic gap close, or will the divergence widen even further? The answer lies in 3 key catalysts that will dictate the flow of global capital over the next 12 months. First, the Federal Reserve's interest rate trajectory. If central bankers execute aggressive rate cuts in response to economic cooling, short-term money market yields will drop rapidly. The $6 trillion sitting in cash reserves will face a yield cliff. A portion of that capital will continue to flow into stock market index funds, but a secondary wave of speculative capital could re-enter high-risk assets, searching for explosive returns in an environment of falling real yields. Second, the crypto market leverage reset. Bitcoin's crash below $60,000, while painful for leveraged traders, cleared the ecosystem of systemic leverage, weak hands, and bloated derivatives open interest. Historically, sustainable market bottoms are built on the wreckage of massive liquidations. Once minor capitulation reaches completion and supply overhangs from government liquidations are fully absorbed by spot buyers, the structural floor for digital assets will be established. Third, corporate earnings durability. The Nasdaq's 21.4% rise set an exceptionally high bar for technology valuations. If big tech companies fail to maintain multi-billion-dollar profit acceleration in upcoming quarters, stock valuations will face gravity. Any disappointment in AI monetization or enterprise spending could trigger a sharp correction in equities, forcing a broader market recalibration. In the final analysis, the great divergence of Q2 2026 was a brutal reminder of the ultimate rule of Wall Street: cash flow is king. When free money disappears and central banks enforce financial discipline, capital will always seek the safety of fortress balance sheets over theoretical narratives. The Nasdaq soared because it delivered billions in tangible corporate profits. Bitcoin crashed because it demanded liquidity in a world that was temporarily running out of it. Whether you are trading stocks or holding Satoshis, remember this fundamental truth. Markets can ignore reality for a season, but in the end, liquidity always writes the final check.